If you're like a lot of people, you've heard of home equity lines of credit, but you don't know what they are, you don't know how they're calculated, how you get one, does it cost anything, how long does it last? Lots of questions are surrounding these products, and I get them all the time. That's why in this video, I'm going to go by a list of questions as a way to answer those for you so that you'd be more comfortable going to your bank and hopefully looking at getting one if that's going to be the best fit for you. Now, the questions that I have, here's a list of them right here that I'm going to go by, and I'm going to go in order so that if you have one in particular, you can skip ahead and figure out which is right up your alley for what you're looking for. But if you don't know anything about them, it's best to go through the whole video and see all about them and what the most common questions are that I get concerning them. So I hope you enjoy it. If you like what you hear, be sure to subscribe to my channel, and let's get started. Going forward, I'm going to use the term HELOC to talk about home equity line of credit. It's just easier to say. It's a little bit of bank jargon, but that way you know going forward. The first question, though, we need to answer is, what is a HELOC? What is a home equity line of credit? That's a great place to start. Very simply put, that is a line of credit that uses your primary residence as collateral. Now, it can be your first mortgage. It can be your second mortgage. It doesn't matter, but it uses your home equity, primary residence, as a revolving line of credit. These loans typically have a lower interest rate than most anything else you can get because the bank knows the odds are lower on a default versus, say, an unsecured credit card, because people are going to do their best to protect their house and they're not going to default if they can help it on that type of loan. So that's why the rate is lower than most anything else that you can get out there. Typically, I've only seen these able to be done on primary residences. If you have an investment property or a second home or something like that, it's not common that you can do those. I'm not saying it's impossible, but that's a very particular type of lender that would be willing to do that. Most everybody out there that lends is going to use your primary residence that you live in to issue you a home equity line of credit. Now, HELOCs are variable rate products that are linked directly to prime. Normally, if you get an approval, the formula for your rate is prime plus or minus something, some number. So if you say your rate is prime plus 1, that means whatever the current prime rate is, you add 1% to it, and that's what your interest rate is at the time. I posted a link in my description to a video that I did on prime rate that'll help clarify it, but it is linked directly to prime rate. So as that rate goes up or down, so does your rate on your home equity line of credit. So it is a revolving line. It is not fixed like a primary mortgage typically is. So how do you get a HELOC? Well, you have to go apply for one at a financial institution that offers it. But let me help you come up with a calculation for it. What the mistake a lot of people make is that they assume they get 100% of the available equity. Say you have a house that's worth $200,000 and you have a mortgage balance on it that's $100,000. That difference of $100,000, a lot of people think that that's what's available to them for a HELOC. Well, most of the time that's not the case. Many lenders will actually restrict below 100% as available to lend to you. A lot of people will use 80%, although there are some circumstances where that can vary. But for our purposes, let's say 80% is that number. So the way you calculate it is like this. If you say your house is worth $200,000 and you have a mortgage that's $100,000, you take the value of your house, the $200,000, you multiply that by 80%, and that gives you $160,000. You take that number and you subtract your mortgage balance, and your total is $60,000. That's what's available to you for your equity for a home equity line of credit. Now, you do have other factors to consider like debt to income and credit score and things of that nature. If you want to know more about debt to income, I have a great video that I posted in the description. I have a link below to help you understand that better. That's another major factor in here too, plus your credit score. But as far as just simply the equity itself, it's almost never going to be 100% available. It's going to be limited, usually around 80%, but that's how you do the math to figure out how much you can get. So let's say you ran a scenario where you do 80% of your house minus the mortgage and the number is 0 or a negative number, chances are you're not going to be able to get a HELOC, period. I mean, you've got to have equity available in your house to use to get one. That's just how it is. And one more note that I'll add on the debt to income here is that when you get one, or when it's going through underwriting, the underwriter is going to assume you max it out and figure out what the payment's going to be in that scenario. And if you can still afford it, if it's maxed out, then they'll probably let you get it. But if that raises your debt to income at too high of an acceptable level, then they'll lower what's available to you, even though you have the equity to work with. They assume you're maxing it out. And that's the case for any type of line of credit. When it's going through underwriting, they're going to assume it's maxed out. What is that payment going to be, and can you afford it? Because if it's available, there's a chance that that could happen. So they're trying to safeguard themselves as an institution in deciding how much to lend to you for a HELOC. So why do people get HELOCs? Well, the most common reason that people do this is for debt consolidation, especially as of this video in 2024 in the summertime. Interest rates are really high, and the rates for HELOCs are pretty high too, but they're still much lower than credit cards and usually auto loans as well. If a credit card is 30% and you can get a HELOC today for 9%, well, that's a heck of a savings. So debt consolidation, rolling them all into one at a lower interest rate, that's a very common reason to do it. Another reason that is common is for home improvement. You want to redo that kitchen, you want to fix up the bathroom, you want to add a room, any types of these things. The HELOC is an extremely popular option to go with, again, because it's flexible and because of the rates very favorable. You can also use it for any type of upcoming purchase, college or an automobile or whatever the purchase is, a boat, it doesn't matter. Once you get the HELOC, you have it. One cool thing about it is whenever you take a draw off of it, the bank is not going to ask you why you're taking it. They just want to know how much of your available draw do you want. So if you want to up and get something that you don't want to tell anybody about, you can do it if the money is available to you in your HELOC that's existing. Once you get it, it's in place, period. You can use it for whatever you want at that point. Even if you hypothetically say you're going to use it for home improvement and then change your mind and don't use it for that, that's on you. I mean, hopefully you do accomplish good things with it, but that's really up to you, so it doesn't matter. You can do it for whatever you want, but those are the most common reasons that people get a home equity line of credit. So the next common question I get is, do I have to pay to get one? Now this depends. So you have closing costs that are going to be associated with it, but the banks that I've worked at, they would waive those closing costs if you met a certain set of criteria. Usually it's applying for at least a certain amount and then taking an initial draw of at least a certain amount within the first month of getting one. But you have to ask your lender that if they have a way to waive those closing costs. If you can't have them waived, on average it's between $500 to $1,000 from what I've seen on closing costs, at least in the state of Alabama. I can't say your state's probably going to be higher. But having those closing costs waived is a great incentive, because if you do that, then it costs you $0 to get it, which is pretty cool, other than a little bit of interest on the HELOC itself, which is still way less than what the closing costs are going to be anyway. And you also want to check to see if there's any kind of an annual fee. Some lenders charge an annual fee to have a HELOC, some don't. You'll just have to ask and find out. But if you can have all the closing costs waived and there's no application fee or no annual fee, then you can get one of these at no cost, just minus whatever the interest is that you pay on the balance that you carry on it, which is a great feature for it. And so if you get a HELOC and then have a balance, how much do you have to pay on it? So I'm actually surprised to get this question all the time, but a lot of people ask me, hey, if I get a HELOC for $50,000, am I paying based on that right off the bat? Well, the answer is no. You pay based on the balance that you have. So if you have $50,000 available, but your balance, what you've actually taken out, is $10,000, then you pay based on the $10,000, not the $50,000. So let's clear that up right off the bat. You pay based on the balance. Now, other banks I've worked at, I have seen where normally they will charge interest-only payments. So whatever your interest rate is and whatever you're charged month to month, that's what's going to be the minimum that's due. So if you have a balance of $10,000 and it's a 10% interest rate, then $1,000 is what you're charging interest for the year, but that's divided by 12 monthly payments. And so they would break that down, and that's what you would be required to pay. Now, I will add this, a lot of people miss this point. This varies from lender to lender, so this is a question that you'll want to ask. But if there's interest-only payments, you pay that, and then anything above that will go towards the principal. Just don't only pay the interest, because then your balance will never go down and you'll get frustrated. Now, things can happen month to month. Cash flow can be tight, so you may need to do that every now and then. But try your best not to make it a habit. Try to get that balance paid down if you have one. And then if a lender doesn't let you do interest-only payments, then it's probably going to be a percentage of the balance, like 3%, just period. So you'll have to ask the lender about that specifically to see how much your monthly payment is going to be. So the next common question is, how long do they last? Now, this is another wide range question. I've seen them last as little as 5 years, and I've seen them last as long as 20 years. You'll just have to ask the lender. But let's go in the middle and let's say it lasts 10 years. That means if you got one today, then for 10 years, you have access to this revolving line of credit. So you can use it for whatever you want to. And then let's say at the end of the 10-year period, you have a balance on it. What most people do is they just go ahead and reapply and get another HELOC and then carry it for another block of time that it was previously. Because if you don't do that, then you have a balance that needs to be paid by the time it matures at the end of the term. But you'll have to ask your lender. The term varies, but a lot of people just go ahead and renew it whenever it comes time to mature. So that's an option for you as well. Of course, you still have to qualify like you would from the very beginning, qualify based on those factors that I mentioned earlier, but that may not be a problem, and you should have more equity to work with by that point anyway. Some lenders will also differentiate between your draw period and your repayment period. So I have worked at one bank where the draw period was 10 years, but the repayment period was 20 years. And so what that means is it's actually a 20-year product, but you can only take from it for the first 10 years. So you draw from it, you pay it back, draw from it, pay it back, and the 10 years has come and gone. And then whatever balance is still there, that remaining balance is set up on payments for the remaining 10 years to get paid down to zero. So whatever the calculation is to make that work, that's how it's factored. Now you can still, in that scenario, when you get to the end of your draw period, if you still need the money, just reapply and get a new HELOC for a brand new set of time like you did to start with. So that's an option too. But you do need to be aware that sometimes a lender will differentiate draw period and repayment period. Those are two different things, and the repayment period is typically going to be longer than the draw period. The next big question I get is, since it's a revolving line of credit with a variable rate, is it possible to fix it, to get a fixed rate, to lock it in? This is another question you'll have to ask your lender, which is the case for pretty much every question I've gone through because it does vary. But from what I've usually seen is that there is a way to lock in an existing balance on the revolving line of credit part and convert it into a fixed term loan. So let's say, for example, you have a HELOC for $20,000 and your balance is $10,000. You can usually take that $10,000, convert that to a fixed term loan with a fixed interest rate, fixed term, fixed payments, and have that in addition to the rest of your HELOC. So you take $10,000, you set it up on monthly payments to pay it off within 10 years, and then you still have the $10,000 available to you as a revolving line of credit. And depending on the lender, as you pay down the fixed term loan within the HELOC, let's say you pay half of it, that $5,000 may or may not go back to the revolving line of credit. You'll just have to check and make sure. But a lot of times there is a way. You can always ask. Lenders understand that not everybody likes the variable aspect of it, and so they will offer a way to lock in the balance into a fixed term product and still have the HELOC available to you. Can I deduct the interest that's on my HELOC? Well, up until 2017, pretty much everybody could. For most people, that was taken off the table. Now, you would have to talk to your accountant to really make sure that it applies to your situation, and if you are one of those that can. For most people in the year 2024, when this video was cut, you can't deduct the interest on your HELOC. It used to be a really great selling tool to encourage you to consolidate other debt and then deduct that interest, whereas you couldn't deduct it on other things. But that is taken off the table. But either way, all the other things that I've said up until this point, it's a great product to have. I love doing them. I love seeing what they can do for people, how they can remodel their homes, consolidate debt, put themselves in a better situation. I believe in this product. It's a great thing to have. I know I have one personally, and it's great for an emergency situation as well. In fact, an additional scenario that I mentioned to you is that if somebody's coming up on retirement and they're freaking out about what that's going to look like, they can get a HELOC before they retire and then have whatever that window of time is available to them as an emergency fund in addition to what they have. As just some peace of mind. They may never even have to use it, but if you have a joint couple, they're retired the same year, and then the income is gone and they're relying on their retirement savings, that may be a little nerve-wracking for most of us. But how would you feel knowing you had a cushion of, say, $200,000 available for a HELOC if you need it in the case of an emergency? All you have to do is write a check off of it. And so it's real easy to get to. And that's another reason to get one if you're approaching retirement. Get one in place before you retire because it's underwritten based on how you are at that moment on your income and assets. Even though that's going to radically change once you retire on the income piece anyway, you still get one based on how you are when you apply. So if you have a HELOC, how do you get to the funds? Well, that one's actually pretty simple. If you also have a checking account where you got your HELOC, you can usually just either go on online banking or contact your bank and they can transfer money from your HELOC into your checking account. And then you can just use a debit card or use a checkbook and just pay it like you would anything else normally on a checking account, but you have extra funds there that came from your HELOC. And then you have a balance that would start carrying on your HELOC if you didn't already. If you don't have that set up, maybe you have your primary checking account at a different bank where you have your HELOC, then you can either get a checkbook that's linked directly to your HELOC. Some places will let you have a debit card linked directly to your HELOC, or you can show up at the bank and withdraw funds via cash or a cashier check and get them that way. We have people that come in who have only HELOCs with us. They'll get a cashier check and then take it out to their bank to deposit. It makes it a little more inconvenient if you don't have a checking account where you have your HELOC, but it is possible to access it, especially if you have the debit card or the checkbook. Then you can just withdraw straight from the HELOC without having to involve your checking account at all. So there are various ways to get to the funds if you have a HELOC. So there you have it. Those are the most common questions that I get about HELOCs, and I swear I get them all the time from people who are thinking about getting a HELOC and unsure about it. Hopefully, if maybe that was you before you watch this video, you feel a little more comfortable. It's really not as big of a deal, not as much of a headache or hassle as people may assume that it is. It's a great product. We do them all the time. I believe in them. Very flexible. It's probably the most flexible product that you can get with the lowest rate. So definitely inquire with your banker about getting one for yourself if you're looking at getting a loan of any kind, or consolidating, or all the reasons that I mentioned to you, plus whatever other ones you may have. Hopefully this helps clear it up. If this was helpful to you, I would appreciate it if you would take time to like the video, subscribe to my channel, check out my other videos, and add your comments. And I look forward to seeing you again very soon. My name is Daniel, and this is Fellowship of the Frugal.